fund administration part, as Clem said, but I think you should really make sure that you're working with a bank, or if you're a fund or if you're an investor, working with someone that has that oversight and there's dual signature control to make sure it's not just one group that has the authority to move, because there's going to be, there's hundreds of millions of dollars in these funds, so you just want to make sure that there's controls in place.
So I think we were going to jump to more detailed on the technical around cash management. And so I know Olivia is going to talk a little bit about the working capital safe harbor and some really favorable enhancements to that we got in the new set of regulations. But just tying it back for a second to the basic concepts of the fund structure that we talked about at the very beginning. So if you have a single tier fund, you have a 90% test that you have to meet. And the testing dates, which I think the prior panel went through, it's basically the first 6 months out and then at the end of the year. And so one of the problems that was addressed with the new regulations, I think the timeline was set out really nicely by the prior panel. If you start your 180-day clock at the end of the taxable year, you basically end up with your first testing date close to the end of the year and then another testing date really soon after that.
And give an example of that, Orla. I mean, if I were to sell my Apple stock May 25th, I'd have to have it in the wrapper by Christmas and left me with 6 days, which obviously was a challenge.
Yeah, that's a big challenge. So now what, and so just so people understand the testing date, so 90% of your assets have to qualify at the fund level. You do have a 10% bucket for non-qualifying assets, which is great, but the working capital safe cash is not a qualifying asset at the QOF level, the upper tier. If you push that cash down to the second tier, you get the benefit of a longer dated working capital safe harbor. So people were really scrambling to get that cash pushed down through the structure to the second tier. And what that essentially does is it takes away your flexibility to then invest in additional partnerships out of the QOZB level, because partnership interests are not qualifying assets at the second tier. So it's all very complicated. You really have to understand your structure chart. But the relief that was given in the new regs on this testing date at the QOF level was basically, they said you can disregard any contributions of cash or property that came in the last 6 months for purposes of the first testing date, specifically for that reason. So it gives you a little more flexibility. And what it means is you could theoretically function with a single tier fund, and there may be really good reasons to do that if you can live without the working capital safe harbor, which I think Olivia will talk about now.
Olivia, yeah, talk about we've got a lot more flexibility now around this working capital, how we can invest those proceeds. Tell us a little bit about this plan. Everyone talks about you got to have the written plan. What happens if, a neighbor comes out and fights the project and says, I don't want a self-storage facility in my backyard? What protections and mechanisms do I have if I'm moving forward in terms of that?
So for the 31-month rule, just to back up a little bit, originally we had that with the proposed regs for real estate. We could use that for acquisition, construction, or improvement of tangible property. Under the new proposed regs, there's 3 new benefits as I see it. One is that the working capital safe harbor has now been extended to the development of a trade or business. So that's huge, because if you come up with a working plan, it doesn't just have to be for improving tangible property, it's also for developing your business. That's really important. Another really important point that it doesn't really highlight, but that I want to make you aware of, is what about the question of, okay, great, so that works for my business, but what if Craig gives me some money on January 1st, and then Orla gives me some in February, and I've got all this cash, how does that work? Well, they came up with a rule that if you're allowed to have multiple tranches of working capital, as long as for each tranche of fund that comes in, that you have a plan, and your plan has to be reasonable. You can't say, oh, I'm going to build this huge mall, and I'm going to get all my permits, and I'm going to do all of that in 31 months when you haven't even started on your permits. That's not probably a reasonable plan. But what about permits? Everybody's worried about that. Well, okay, so I need to entitle my property. I don't have my permits. What if, like in DC, as Craig knows well, you could apply for permits and you could sit around for a long time and not get them. So that was brought up. They had a meeting, and they had at the IRS, they had a hearing, and then they had a meeting at the White House about what our concerns were. That was one of them. So they gave us the exception now, that there is an exception to this rule if you don't meet it, as long as you've applied for your permit prior to the expiration of the 31-month period, and you're not able to receive your permit, as long that would be an exception, because you're waiting on the government, you're waiting on a third party to get that permit. So I think that should be really helpful for projects going forward. And that was a bit of a surprise that we were able to get that.
What about, and we talk about clocks, and everyone always gets confused because there really are almost 4 clocks. Tell us a little bit about the 30-month clock and doubling the basis. Obviously, they addressed, as Orla alluded to give us 6 months for that initial timing test, for our first timing test of good assets. Tell us about the 30-month test, because that wasn't extended, and kind of how that plays into the program, because you gave me a breakdown in the 31 months, but I still got to double my basis in 30 months.
Yeah, so Craig is talking about there's 2 rules, and everybody confuses the time periods, the 31 and the 30 month. So the 31 month is for the working capital safe harbor. That's because cash is not a qualified asset, so you can only have 5%. On the other hand, there's another rule that if it's not original use, and we can talk about that later, you have to substantially improve your property, exceed the adjusted basis you paid for the property. That would be for the building. It does not include the land that the building is sitting on. That's still 30 months. And then there was confusion, when does that start? Because we had the proposed regs, then we had the blue book. But we believe it still starts on the date of acquisition. So you still have, Craig's right, you have the 30-month rule that you have to substantially improve your property. But you have a 31-month working capital safe harbor. So we have a little bit of difference in time periods.
But I think it is worth just highlighting that the waiting for government action exception on the working capital, while hugely helpful, we actually got something even better for ground-up development projects, which is you can now treat those as original use.
Tell us about that, and also the 5-year kind of vacancy and the flexibility now, because we really have 3 options: substantial improvement, original use, or 5-year vacancy. So just outline real quickly kind of the differences.
Well, that was the nutshell summary, but I think the original use rule,
There's a lot more than that, though.
we thought the original use rule was already there, but there was some uncertainty about whether you'd be able to rely on it. But so they basically created a very clear dividing line of if property has not previously been placed in service, it's considered original use property, and so the whole substantial improvement rule where you have to double your basis and you worry about your allocation between land and building and what if you demolish the property, that's all gone for ground-up development or really anything that could be placed in service for the first time. And then the 5-year vacancy, I don't know how useful that is. I think we were hoping for better on that like if a property had been vacant for a year, that you'd be able to treat it, or 2 years, you'd be able to treat it as original use. So we didn't get such great guidance on that, but I'm pretty happy with the original use, and I do think it helps because people who thought they had to manage that 30, 31 month around ground-up development don't have to worry about that anymore as long as they can satisfy their cash management.
Michael, let's bring you back in here. A lot of people, obviously, and especially real estate holders, are trying to evaluate, well, do I just continue down the road, keep doing 1031 exchanges, or do I go ahead and do an opportunity zone fund? Walk us through briefly, because you've been very involved in kind of the 1031 space as well. Talk to us about some of the main key differences.
Sure. I know Craig has a slide up there, and we won't have to go through that step by step, but I think there are the three major points that I take out of it right now are 1031 has to be real property. As opportunity zone, we know it can be any capital gain, stocks, bonds, property. So that's one. Secondly, when you eventually sell your 1031 property, you're going to pay capital gains, the full capital gains. As we know, if you hold the opportunity zone for 5 years, you get a 10% discount. 7 years, you get a 15% discount on your capital gain. So that's another one. But the one that I find the most interesting is, if you hold your investment for 10 years, as we know, you get a step up in basis and you won't pay any capital gains on your original investment. And they're the 3 that I find to be
perfect. Clem, in 2 minutes, tell us about, now we've got some more flexibility and a lot of the rules focused on people. One of the main concerns going into the second set of regs was the exit. We really created a lot of issues about having to sell your partnership interest and what that meant. Tell us about kind of how you view it now and the additional added flexibility about being able to sell these assets and create this commingled, something that looks more like a traditional commingled fund.
Right, exactly. I also, before I get into that, I wanted to say something about the government tolling of the 31-month time period. It also should apply to litigation, which is key. That's touched one of my clients who's closed on a property, and now there's a fight about this or that. I can't get into it, but we're pleased that you know, the judiciary is also government action, and, you know, they won't fall prey to the 31-month window.
The keywords are waiting for government action. We don't know what it means, but it
Right.
seems pretty broad.
Right, exactly. Okay, and so, anyway, now I guess I only have a minute and a half, but I'll try to, in terms
A
of...
minute and 20 seconds.
Okay. In terms of what I call redeployment, and more specifically, in this case, I want to talk about how you can, well, what happens if you get value, if you divest of an asset in your fund during the 10-year period of time. If, what?
I was joking, I said no, it was like 40 seconds.
Right.
Very serious timekeeper here.
I know, exactly. Okay, so you got 10 years, the fund, you know, you got to hold this investment in the fund, but the fund has the ability to divest of assets and redeploy that capital. The fund also has the ability to refinance and get capital that way. Assuming a 2-year period of time has passed, if the fund is able to refinance its existing properties, that creates a scenario where, well, taking a step back and talking about basis, you have no basis in your investment in an Opportunity Zone fund. However, if the Opportunity Zone fund refinances, that will create basis, which then gives the fund, which then has the ability to be offset. So as a practical matter, if there's a refinancing that occurs, if you have $50 in the fund and then they refinance for another $50, that's so there's 100 there. That's $50 of basis you have, and the fund can do a distribution to you that's not going to be included in gain, and it's not going to impact the original investment that you made. So, as a practical matter, at year 7, when you have a bill to pay, if the fund is in a position to refinance, they may be in a position to get, to create basis and get a distribution to you, which might totally or at least partially offset the bill that you have at year 7.
I'm going to let, just because we want to leave a few minutes for questions at the end. Orla, in 90 seconds, exit, and then Olivia will let you have the last word, and then we'll throw it out to the audience for questions.
All right, so we covered what happens with distributing cash over the life of the fund. So how do you get your 10-year step-up benefits, which is kind of the grand prize here? You have to, as we said, the statute says you have to self-fund interests, so not assets, and not your lower tier QOZB interest. That's what the statute says. We have so the original thought was you set up separate QOFs for each asset, and then you can sell those in the QOF interest, and that's essentially the same thing as selling one asset, at least within the construct of a multi-asset fund. And we had REIT structures that we could use as well. There's a new rule that gives you some additional flexibility to not sell assets, but rather sell the property held by the qualifying property held by the QOF, which in a 2-tier structure would be the lower tier partnership interests. So if you sell those, you can pass through that step-up benefit through the fund, which is great. But with feeder funds that you can now do by contributing your QOF interest to a feeder fund, you could also kind of replicate a structure where you sell QOF interests through a commingled feeder fund, which is also very helpful. There are definitely details around this. There may be circumstances in which you are not better off. You could sell assets, or you could sell QOZB interest in or things underneath the QOZB and get to the same place as if you sold QOF interests. But we do think in general people are still going to want a structure to sell QOFs.
Orla, real quickly, just so I have the maps up, and also on my LinkedIn page, I have these slides that you see. I see several people, if they're worried they didn't get it, or the 1031. Feel free to download it, knock off the slide, whatever you want. Just make sure this one I knocked off from Orla, and I want her to talk briefly about the work that Leanne Scott's done, her colleague in Northern Virginia, specifically addressing just really quick state tax conformity. And then, Olivia, one other thing that we didn't address, which I think is important, recycling of capital really quick, and then just final words. So tax, recycle, closing.
So conformity?
Yep.
Okay, so number one.
Sorry, I'm just trying to get as much in as we can.
Number one, this map needs to constantly be updated because it seems like there are new developments on the state and local front every day. Essentially, some states automatically conform to the federal tax code, others have to do something to conform proactively. Others have just chosen not to. Some have even discussed decoupling from the federal tax code. And there's a handful of states where they're talking about, I think Ohio's actually implemented a refundable tax credit on top of the federal tax benefit. So it's an interesting map. Definitely affects your tax-affected IRR if you're investing multi-state. So you want to really pay attention to these benefits.
Recycle, closing words.
Sure. On recycle, if you sell assets, you in the fund or down at the opportunity zone business level, you have 12 months to replace them. You have to replace the assets in 12 months. I wanted to say three final little points. I get a lot of calls from clients asking me for the Good Housekeeping Golden Seal of Approval that they are a qualified opportunity zone business. They want to know, where do they get that seal of approval? Where do they get it? You don't get it. It's not anything that you could write to Treasury or the IRS or anything like that. So we put together a 5-page checklist, and we go through that with our clients to make sure that they qualify. You do want to be really careful about that, because if you're taking money from other people or from like Craig's fund, you don't want to tell Craig that you're a qualified opportunity zone business because you just quickly looked at the rules, because they're actually really involved if we have a 5-page checklist. So you want to make sure you run through that and be really cautious and careful with that. So that's one. Raw land, so you have to improve it by more than an insubstantial amount. That hasn't been defined, so I get a lot of questions. Can they buy 50 acres of raw land and put like a little lunch stand on it? And what happens with that? It is a trader business, it absolutely is, but is it enough? Or is it going to be caught by the anti-abuse rule? So that hasn't been answered. I imagine that will be answered in the future. And then the third point for you is what I mentioned in Los Angeles with Craig, is that you have to substantially improve the property. But a lot of my clients are buying multiple tracts. Like we have one in South Carolina. So then the question is, that I think Greg gets this too, do you have to substantially improve each track, or can I just aggregate them and work in the center and not worry about the others? We were hoping they were going to